Eric Muathe from Muathe.com with US market analysis for the weekend of December 3rd and December 4th, 2016. Let's take a look at markets here. We had a down week for the NASDAQ, down about 2.6%. And more telling here is this failed weekly breakout. So the NASDAQ right now we can say is failing to hold above the previous weekly closing high breakout, and that level is at 5312. So that's a failed breakout, not a good sign for what the market wants to do short term. And also we can see that if you go take a look at the 3-year weekly for the NASDAQ, the level we were watching for resistance on the RSI seems to be shaping up. As you can see here, the market has come and tagged that topside resistance and we seem to be stalling. So that can be a reason here to start suspecting that this market is not sitting pretty, as long as we are coming back and showing resistance on this well-defined resistance line on the weekly RSI for the NASDAQ. Also keep in mind that on the monthly, as long as the market is below the previous monthly closing high, which again is at the same level, which is this monthly closing high, now that we had spent a month above that level and now we are back below it, as long as we are back below this level, in other words, as long as this is a failed breakout attempt, that sets the stage for a market that wants to go down, unless the market can move back up and recapture the level above 5312. Net conclusion here is that the NASDAQ at the very least is now pointing downwards. Keep in mind, there's also the aspect here that we made an improvement in price highs over the last couple of months, but the RSI did not show any improvement. Also, we can see that we've seen rejection twice, rejection here and again here on the RSI. So while the market was making these highs here, we have double top rejection, and this rejection happens to be at RSI of 61.8 level, which is a big deal in my opinion. So that negative divergence is the worst type of negative divergence. Now let's consider also this line here. So let's draw a line somewhere there where the market is stalling right now. Okay, we can see here when we stalled here, we made a high right there, and in the subsequent months we drifted lower. We've come back again, we're doing the same thing here and here. That's a big deal as long as markets are down for the month. In fact, if you really want to paint a better picture, take a look at the long-term picture for the NASDAQ. What we're going to do here is draw a simple line like that. So this line here corresponds with the double top rejection we are seeing here. And also, it gives us interesting insight. Here, we had another instant of a double top on the line, which is the highs there in 2000, before we had this major drop. We come here in late 2007, and we break down, which coincides with the break below the red line. That break was good enough to begin this major bear market in 2008, early 2009. So what I'm saying here is month to month, this is not a good setup for the NASDAQ. As long as it remains down for the month, chances are that now we are pointing to a situation where markets could easily be probing much lower prices from current recent highs. As far as the Dow is concerned, long-term monthly charts for the Dow going back to 1998, we can see here we've been showing an improvement month to month, but here we see the technicals are stalling. That negative divergence, if the market turns down for the month, so right now the Dow is up for 46 points for the month of December, but if it turns down for the month confirming resistance, that's not a good sign, because the RSI would be confirming resistance on this line here. That break line brought the market lower in 2015. We are coming back essentially to test the break line there. If we turn down for the month and show rejection, so if this is confirmed as resistance month to month, it's not a good sign. And also we can test that line by going backwards, and it coincides nicely with major breaks. Major trend line break here, which is the break off the highs late 2007 before this mega bear market period, also coincides with the break here off the highs of early 2000, which led to this gradual move into a major bear market. So showing resistance here is not what bulls want to see. If we see confirmation of resistance, again, another market that could be suggesting that lower prices are now back in play. We take a look at the S&P 500, and just like we saw with the NASDAQ, the problem with the S&P 500 right now is it is already showing topside resistance on its weekly RSI. As you can see, this is where we're expecting resistance, and we seem to be getting that. So as long as the S&P 500 is below this topside resistance line, the equation, in my opinion, has changed now, and markets seem to be set to go lower, unless at some point S&P 500 can find a way to move above the blue line on the RSI. But for now, net, I would assume that this is suggesting that we should not be surprised if the markets continue to drift lower. One thing we can do here is watch the recent breakout level for the S&P 500. And so let's give that number there. And that number is at 2184.05, which happens to be this weekly closing high. If the market is above that, now maybe we can still give it the benefit of the doubt. But if we drop below that previous breakout level, in other words, if we join the NASDAQ in failing to hold above the breakout, that would be confirmation of markets that want to go down. So to conclude here, as long as the S&P 500 is above 2184.05, expect the market to be stable. But if we move below this price range, now we are confirming that the true next swing trade is definitely to the downside. Subscribers, be on the lookout for part 2, which should have my analysis on commodities as we do every Sunday. And don't forget also that I should have some ideas for you to consider as we go into the new week. Again, Eric Muathe, Muathe.com. As always, good luck, peace, and blessings. I'm out. Yeah! Woo! Yeah!